This is Bloomberg Intelligence.
Usually when the consumer's under pressure, dollar stores do really well.
We still see R&D spending for the big biopharma companies holding steady.
In-depth research and data on 2,000 companies and 130 industries.
The one area that Netflix hasn't yet ventured into is sports.
As dominant as PepsiCo is, it can even do better.
Bloomberg Intelligence with Alix and Paul Sweeney on Bloomberg Radio.
Welcome to the Bloomberg Intelligence podcast, where each and every week we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
I'm Alix, everyone.
And I'm Paul Sweeney.
Today we're going to take a look at what's ahead for the banking sector. You got some smaller regional lenders are seeing some loan loss pre-announcements. That's never really a good sign. Bloomberg Intelligence senior U.S. regionals bank analyst Herman joins us now to explain. Basics. What are loan loss pre-announcements? Like what you're setting aside for bad loans or what?
So basically the banks, certain banks in the Southeast have pre-announced in their earnings for the third quarter some charge-offs. So defaults on their lending based on some syndicated loans that they've syndicated out to a bunch of smaller regionals in the Southeast. And it basically revolves around one credit, a gas station operator that is pretty large down there, and it's creating some hiccups in terms of credit quality for the regional banks. And we highlight First Horizon, which is a bank based in Tennessee, that basically their loan losses, their charge-offs will go up basically 3 times versus what they've typically done in a quarter.
So if I'm a regional bank, what's my loan portfolio look like? Who are my borrowers?
Yes, so your borrowers are typically smaller middle market type companies in the region that they operate in. So think of mom and pop type commercial businesses, commercial real estate owners and operators, and also the consumer folks that are in their particular footprint. So lending to residential mortgage borrowers and the like, maybe some credit card borrowers within their depository base. So that's typically what they do.
So what happened with this one company?
So it's hard to say. We actually did look at the bankruptcy filings to dig a little deeper. And what we found is that basically the owner of the properties basically pulled the rug on this operator, and now it's in liquidation.
So is this like a trickle down of commercial real estate?
It potentially could be. I think that's a good read across, but without knowing more about the issue, it's something that none of the banks really anticipated, and with it going into liquidation, it just means that there's more losses for these companies versus a reorganization type process.
When I look at a regional bank, how are their balance sheets? How's their capital relative to some bigger banks? Do they have the same cushion? Because a lot of folks like you have been telling me that it's different this time as opposed to the great financial crisis. Right.
So capital is something that is a bit of a moving target right now. The largest banks will need to have higher capital ratios because of some of the changes underway that the Federal Reserve has articulated. So that's something that is and big bank CEOs like Jamie Dimon have already come out really forcefully to complain about some of the changing rules in the hopes that the other folks at the Fed will potentially add pressure to Vice Chair Barr to alleviate some of these more onerous aspects of increasing capital rules. So that's something that's happening. The regional banks also need to contend with higher capital ratios, but it's not to the same extent that the big banks are facing.
So there's like two different things. Like one is the structural issues with these capital changes, and the other one is the trickle down from this bankruptcy that may or may not be commercial real estate related. So is there just also general stress in the system? So the idea is that you have higher yields, certain companies get under stress, and that's going to trickle down to the regional banks. With the exception of this thing, is that still happening?
Yes. We haven't seen losses yet, right? Even though every week we see commercial real estate nightmare type scenarios written about in the financial press, the actual losses really haven't materialized. But what the regional banks are are reporting is that some early indicators like commercial criticized loans is a metric that we like to look at quarter after quarter. And those are sort of early warning signs of potential stress. And those numbers are increasing at the median for the regional banks that we cover by 8%. It grew by 9% last quarter in the first quarter. So continued growth, which just means that regional banks are more cautious going ahead. And another sign of caution is that the reserves, the reserves against the loans are continue to increase, meaning that they're cushioning it for potential losses ahead. That's happening across big banks and small banks.
So as loans are coming due, I got my construction loan. It's sitting at 3%. I'm happy. I'm making a nice return. Now I come back to you and refinance it, and now I got to pay something, 6, 7, 8, 9%.
Exactly.
Is that what's happening out there?
Yeah, those are the tough conversations that are happening as loans continue to become due. What's good is that not every loan is going to come due at the same time. So there is a bit of a lag effect for the banks so they can manage some of these issues, right? So these conversations means that the borrower may need to inject more equity into a construction project in order to get a renewal of their loan. So, or they need to put more skin in the game or just have some personal guarantees on that. So these are some of the things that the borrowers continue to face and are some of the risks that are inherent in this current environment where rates are much higher than a lot of folks expected.
But the good thing about the loan loss provisions is that they can always also come out. So you're putting them aside for bad loans, but the bad loans don't materialize, then you get to get that money back, and then that actually helps your earnings that season. When's the drop dead date for that? Like, when are we going to be like, all right, things are okay?
Yeah, it's going to be much longer than the third quarter. That's going to be reported in the next few weeks. I would say that the banks continue to add to reserves, but one good thing about banks not lending, which is something that we've also written about over the past few quarters, is that if you don't lend, that means you don't have to add to reserves because there's no reason to pad against future loan volume. So that's actually helpful for stabilizing the reserves potentially going forward.
With the banks not lending as aggressively as in the past, maybe since the great financial crisis, that's created, incentives for this private credit business that has just been exploding in terms of growth over the last 10, 12 years. Do the middle markets, regional banks, do they compete against that private credit?
There are certain aspects that the regional banks will say that they face versus these non-bank lenders, these shadow market lenders that you're talking about. So increasingly, there's competition from forms like BDCs and middle market credit lenders that aren't in the banking system. So that's something that the regional banks have contended with since the financial crisis. I would say that most recently, or more recently, the regional banks have pulled out of certain markets like consumer auto lending, for example. And there's been some reports that the private lenders are entering this market for the first time. So in a new normal, when things are a bit less shakier, that could just mean that there's going to be less growth or less lending in the banking system and more growth in the shadow lending system, which I don't know really if the Fed wants that to happen, but it's just going to be a byproduct of what's going on in the environment.
It's probably good that the regional banks aren't lending as much in terms of slowing the economy, but not so much if the risk is just being taken off elsewhere.
Right.
Do you feel like all of this that we're talking about is adequately priced into stocks as we head into earnings season for these guys?
Yeah, if you just look at some of the valuation metrics for the regional banks, we're talking about 1.1 times tangible book value, which is a really low valuation for if we're talking about the historical experience. And the negativity reflects all of the things we talked about: tougher regulations, potential weakness in credit quality going forward, no real balance sheet growth because the banks aren't lending. shrinking, margins are contracting because of higher deposit and funding costs, and there's just no real catalyst in the near term to really alleviate some of the negative sentiment that's really permeating the group ever since the bank failures in March and April.
If I want to open up a coffee shop in a vacant storefront in my town and I go to my local bank, can I get a loan to do that?
That's a good question. Do you have some personal guarantees? If the loan goes bad, are you willing to step in and make the bank whole? That's probably
So it's tougher today than it was.
It is.
Oh,
it
yeah.
is. Do you have a history of operating a coffee shop?
Like a coffee shop on the shore, Paul?
Sure.
Is that something you're looking at?
I mean, for a summer business,
Yeah,
like
I don't
maybe.
know.
If you got a business plan, maybe I can chip in.
Look at this.
Very good.
Hashtag one team. All right, Herman, thanks a lot. Bloomberg Intelligence Senior U.S. Regional Banks Analyst Herman Chan.
That's this week's edition of Bloomberg Intelligence Podcast, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney, and this is Bloomberg.